Regular on CNBC saying that, look, you got to know when enough is enough. Let's continue our talk with our three pros in terms of trading strategies that will work for you in 2009. But before that, though, I want to get to an email. This is a lady named Ping Ping writing in from Singapore. She wants a view on where the Australian dollar is trending against the Sing dollar, AUD versus SGD. Chris, what do you figure?
Well, I think the key here is that it's actually not trending. But volatility in the Aussie Sing, which has historically been very low, below 5%, has sharply increased in the last year. And this provides great opportunities, and we actually feel that as a whole, volatility in FX provides great opportunities. So in Aussie Sing, for example, I think anything towards 95 Sing to the Aussie would be attractive to look to buy. Okay. I don't think when we see the lofty levels we saw last year above 115, 120, forget 130. Okay. Anything, so effectively you're trying to take advantage of volatility and play a trading range 95 to about 110.
All right, noted there. And Ping Ping has a second part to her question. She also wants to know when is the right time, is it the right time now to start doing some cherry picking of financials, that is banking stocks? Kirby, what do you think?
Sadly, no, not at all. The banks have, the financials have a lot more pain to come. And if you look at, for example, foreclosures, the mortgage market in the U.S., we won't even get into credit card secured loans or auto loans or student loans, the whole thing. Let's just talk about mortgages. They're talking about in the U.S. Congress, and they're getting closer to passing a bill that will allow people in Chapter 13 bankruptcy judges to renegotiate the terms of the mortgages. There are two choices here for banks. Foreclosures either balloon or people are kept in their houses with judges deciding just how much they have to pay back to the banks. Either way, I don't want to be touching the banks that are going to be subject to judges deciding how they're going to keep them in. I don't want to be touching banks who are going to be dealing with the foreclosures that are going to balloon on the other side. Okay,
interesting stuff, Aaron. I didn't mean to leave you out there. I mean, what you guys do is black box trade. It's algorithms, basically. It's fire and forget, right? So you don't need to be thinking about stuff like that, do you?
Yeah, certainly any kind of active trading strategy like a managed futures fund should outperform a long-only equity strategy. If you just think about it, there's $32 trillion worth of stocks worldwide today. Compare that with about $84 trillion in bonds. So that means the world is essentially leveraged today, or has a debt-to-equity ratio of 2.6 times. But that doesn't even get into the fact that with derivatives, there's $275 trillion worth of derivatives out there. It just doesn't even get into the fact that there's just a tremendous amount of leverage still out there. And that's going to put a tremendous amount of selling pressure on equity markets for years to come.
Yeah. Okay, but I mean, just a couple of minutes ago, we were getting into this whole issue of volatility. There's extremely high volatility where your funds are concerned, no?
Absolutely, and I would completely concede that we have a high volatility. We also provide a high return. There's no free lunch in the markets, as we've seen. And if you want a high return, you also should look for something that's realistic, that has a realistic amount of volatility. There is no free lunch out there. So since we started trading in 1996, about 13 years ago, we had an average return in our basic strategy of 18%. Our most aggressive strategy is annualized 31% per year since 2001 when it started trading. So we do have a high return, we do have a high volatility, I'd concede that. But here's the best part for viewers and for investors to know. All of that volatility is magically erased by the power of non-correlation. Because managed futures, since we started trading, our correlation to S&P 500 is minus 0.11. Our correlation to commodities, 0.17. Correlation to hedge funds is also quite low, around 0.2. So by adding a managed future strategy into a portfolio, you almost automatically reduce the overall risk and enhance the returns. This is actually what we call the Baja portfolio theory, which is actually just an extension on Markowitz's modern portfolio theory, that any investor can essentially reduce their risk and increase their returns by adding up to a third of their portfolio in a managed future strategy.